Welcome to Mortgage Talk 101 here on Super Talk 1270. Time to look behind the numbers. Buying, selling, refinancing. Mortgage Talk 101 addresses real issues in real estate. Now, live from the Super Talk 1270 studios, here's Mortgage Talk 101 host Joe Sheehan.
And we are back on the radio, Mr. Housing.
Dave Flora right here.
And I'm your Body Built for Radio.
Joe Sheehan.
That's
How about
right.
that?
Feeling good.
Back from Nashville,
feeling all
Tennessee.
countrified.
All right. Did you bring your guitar with you when you went down there?
I tried to buy one down there, but you cannot buy a guitar on Music Row.
Oh yeah.
There's no guitar store.
What?
On Music Row?
That's amazing.
Isn't
Wow.
that amazing? Yeah. I don't know where you'd have to go in Nashville to buy a guitar, but
Wow.
really. Now I don't play guitar, folks. I own a guitar, but I thought it would be cool to buy one and say I bought it on.
Yeah, this one I got that one in Nashville.
When I was in Nashville, I bought it on Music Row.
Yeah, you got it displayed.
And maybe you could find one that was played by a cool band or something like that, or a local group or something that and that had been traded in. I didn't know. I was looking for something, and you cannot. There's no music store with guitars being
Weird.
sold on Music.
That is very. You would think they would have all the equipment.
No,
I'm sure they do somewhere. They've got
Well,
to.
obviously,
Nashville, obviously
there's big.
I mean, it's part of the trade. It's it's an industry.
There's a store somewhere. It just wasn't on Music
Yeah.
Row.
Yeah, not on Music Row.
Yeah.
And so I the big thing that the other thing that I was there was one disappointment I had with the whole Nashville experience. Is that we didn't hear any original music. It was all covers. Very talented bands, a lot of great music, tons of great country music. Had a great time. The establishments, the bars, they're phenomenal. But no original. It was all people playing covers.
Well, the place to go for great original country-themed, tinged music would be Texas. If you're ever in Austin, Texas. There's a bunch of clubs down there. You can hear some great stuff.
Here's some artists trying to break their own
it's a
stuff
different
out there.
flavor of country. It's more progressive. It's got a little more.
That's
it's a
ZZ
little
Top.
edgier. Yeah,
That's that ZZ Top.
I'm not talking about hard rock. I'm talking.
No, but that has
people
that
like
whole
Robert Earl
flavor.
Keen and Steve Earle. Those edgy.
Texas has that whole flavor though,
Right.
Of just being a little bit different, more driven by the electric guitar.
Yeah.
Well, I suppose Nashville's a tourist thing, and people want to come. Oh, they're going to step in a bar and hear something. They want to hear a song they know.
But you would think that in all this time that there'd be one bar that would have established
Somewhere.
itself as the one that kind of breaks out new
Let's
artists or
bring
something.
the
like
artists
that,
in.
right?
Yeah.
Went to the country.
You probably had to go off the beaten path. for
Right.
that, maybe.
Yeah.
Yeah.
But,
Get away from the touristy areas.
Country Music Hall of Fame. Went to see that. It's lots of cool stuff. Was at the world famous Wild Horse Saloon. But a lot of and actually I was there, folks, for work.
Yeah. Yeah. Regardless,
We have
were
some
working.
information. We have some information.
Oh, okay. You
from
brought
a conference.
something
I
back.
did bring something back.
Oh,
for
you
the
got
show.
one little note there. I see.
I wrote down one thing just to say that.
Well, they always say if you go to a meeting, if you come away with one thing, it's a success.
So the barbecue is phenomenal down there.
Okay. That's your note.
That is one thing I learned.
Okay. All right.
So let's go ahead. What you've got the Freddie
Interest
Mac
rates.
report. Go ahead and give them to us.
Interest
Mr.
rates.
Housing.
30-year fixed rate mortgage average rate this past week, 4.14. That is up 2 basis points from last week, where it was 4.12. The 15-year is at 3.27, which is up 4 basis points from last week, where it was 3.23. The beginning of the year, though, the 30-year fixed rate was about 4.53. So from January 1 to now, it's
They're
dropped
down.
almost 40 basis points.
So it's a good deal. And we talked about this last week. We talked that there was a slight trend upward. And
last week
even
there was,
the report was down.
Yeah.
The report said interest rates were down, but you'd already missed it by the time the reports had come
Right.
out because interest rates had already
Yeah.
been on the trend
and then
upward.
Wednesday evening and Thursday it went back up, but now it's gone down. The rates went back down, so it kind of maybe achieved a pretty good balance here.
Yep.
It's basically
Yep.
flat.
Good deal is basically the
Yeah.
bottom line. What's affecting them? What's impacting interest rates today? Well, the Labor Department reported that weekly initial jobless claims fell by 14,000 in the latest week, 289,000 below the 308,000 expected. Claims are now at 8-year lows as the labor market continues to improve. And we all know that as that, but for the most part, that didn't impact interest rates. Because the Fed is still in there buying mortgage bonds, and so right now interest rates are actually staying at the good levels, steady where they're at.
Yep.
And we're not seeing as much impact as expected by this positive unemployment report.
Because I think we've talked about this before. The market's probably already priced all this news in. There's nothing terribly unexpected happened. I think the jobs report was maybe a little bit better than what the estimates were, but I think that's still.
They expect
the market kind of build this.
Jobs are getting better, so let's get past that.
Yeah, so
we need something else new.
Yeah,
we need some other good news.
It's got to be some really big.
Now we need some really good news
to have a big jump.
Now this one, of course, helps everybody out understand. Everybody out there that thinks that you need housing reform will appreciate this, because here's the proof in the pudding.
Okay.
Both Fannie Mae and Freddie Mac reported positive earnings in the latest quarter, while continuing to repay the government bailouts during the financial crisis. So shut them down.
Well, and then,
that's the only conclusion you can draw from that, correct?
Yeah, well, they had to take all their earnings and give to the Treasury. So
they would have already paid this back, right?
Well, they already paid everything back.
If they weren't paying like a payday rate loan interest rate on the loan that they got, they would have already paid this back.
What is the interest rate when you have to pay everything back and you never pay any of the principal back?
That's 100%.
That would be 100%.
That's 100% APR.
Yeah.
Well, actually, the APR. Who knows if they're begin to charge other fees? The APR might exceed 100%.
Yeah. Boy, you talk about that. That's messed up, man.
But no. So both, like I said, both Fannie and Freddie reported positive earnings in the latest quarter. So, like I said, the only conclusion you can draw if they're succeeding making money and paying everybody back is that they must be shut down.
Yeah. Well, of course. Why would you keep around something that kind of works?
Yeah.
No,
I mean that's
and just tear it down and then put something brand new in place.
I mean, it's no different. It's no different than the auto industry. When the auto industry turns a corner and starts making money, we need to shut it down.
Okay. Yeah,
we shouldn't be bound to just 2 or 3 auto manufacturers.
I have an article for today that I think kind of goes to this.
I'm kidding, folks. I hope everybody understands I'm kidding.
Yeah, he's always kidding. But I have an article that goes to kind of this, and maybe we'll get into it later. It talks about how economies collapse, and it talks about systemic friction.
Oh, yes, we are going to talk about that.
And I thought that was a very interesting thing to look at. So we'll look at that. Let's see what else we got. Well, how about a by the number thing? We got a couple minutes here.
Yeah, let's hit a couple by the numbers as we go into the break, and then we'll come back with by the numbers, and then we'll get into millennials and their house buying experience. I've got stuff on the loan officer experience from the conference, and of course we got the systemic friction.
Okay, numbers. Okay, Joe, the Fed currently pays U.S. banks on the reserves that they hold at the 12 regional Fed banks. They pay them 0.25%. Okay, 1/4 of 1%. The banks have $2.5 trillion in excess reserves that they hold at the regional Fed banks. How much is the daily interest on that? What do you think?
On $2.5
trillion. Yep. The banks just have parked at the Fed.
Well,
daily interest
isn't the daily interest they're collecting on it isn't it like 1.5 or 2%?
Yeah, the daily interest.
So it's got to be $450 million
on these reserves. The daily interest is $17.2 million.
Oh, daily interest. I'm sorry.
Daily interest.
Yeah, $17.2 million.
Daily interest. That's a lot of money.
That's a lot of money.
Yeah.
So then on the course of let's get the calculator out. 17 mil
365
times 360. Well. Yeah, that's right.
It's daily interest.
That's 6.
Too many zeros?
6.
Yeah. Too many zeros.
Is that $6 billion?
That would be $6 billion, I'm sure. Yeah. It's a lot of money. Wow. Anyway, just leave your money parked there.
Yeah.
Why lend it out when you can make $6 billion? Yeah.
All right, folks, so when we come back, more by the numbers. We're going to talk a little bit about millennials, and we're talking about the loan officer experience with consumers, all here on Mortgage Talk 101 after the break.
You're never more than a few minutes from a weather update here on Super Talk 1270.
Got the mic a little far away from me there. All right, well, we are back. Mortgage Talk 101. Joe Sheehan, your body built for radio.
We're animals today.
Or am I the body built for honky tonk? Oh. I might change it.
Well, you're honky tonk, yeah. This week. Well, live the dream for a little while.
Your body built for honky tonk.
Yeah. Okay. All right. We'll go with that,
I'll tell
Joe.
you this. Apparently, they don't sell shoes.
They don't sell shoes or guitars.
They don't sell
on
women's
Music Row.
They don't sell women's shoes in Nashville.
Wait, were you buying your wife's?
No, because all the girls were wearing cowboy boots.
Oh,
that's all you saw was cowboy boots everywhere. It's like these poor girls.
I thought you were going to say there was no shoe stores in Nashville either.
These poor girls can't buy shoes in Nashville because all they can get is cowboy boots.
Boot shoes.
There were lots of boot shops.
Boot shops, yeah.
Lots of
guitar shops.
Boot shops, no guitar shops, and no shoe stores. Apparently,
no shoe stores
because all women can buy in Nashville are boots.
Boots.
And all right, so. Millennials. Not all millennials are created equal.
Who is a millennial? What,
Not
80?
Me.
What is it? Like you were born in the 80s to 2000, right?
What is it?
84 to 2000?
Today's 20 to 29-year-olds are still likely to follow the same pattern. No, that's not them.
Yeah, that would be pretty close.
Yep, that's them.
Yeah.
20 to 29-year-olds.
Yeah,
okay. Yeah, so Mr. Housing,
okay.
Take it. What do we know about these millennials? I got a couple comments.
Well, they're being dissected more intensely than a frog in a high school biology class.
It's a big marketing group.
That's me.
It's
sorry.
It's a big marketing group. Everywhere you go, it's how you reach the millennials.
It's a big deal.
How do you talk to them?
It's a big deal because
what do you do when they won't text
lending?
You back?
They want people. That's the place for home buyers. Is that
first-time home buyers?
Mid 20s, early 20s, and they're not buying homes right now.
No, because they have student debt.
They have student debt is one thing, but
they're still living at home.
Not everybody's the same. There's reasons why they're not buying a house.
They put off marriage.
Debt. They're putting off marriage.
They're not having kids right away.
Yep, lots of things. But this is an article from the Housing Wire here, and they talk about the media is making such a big deal about this, and that kind of perpetuates the myth that everybody that's 30 years old is stuck at home with mom and dad because of all their student debt and everything else, and they're not buying a house, and they're all living together, renting a place, and that's not true. I mean, everybody's.
It's not.
It's not. It's all different. The reporter, this one reporter, Jessica Glanza from The Guardian, said, based on everything you've read, my boyfriend and I are freaks. We're millennials and we're trying to buy a house. They're freaks. They're trying to buy a house, Joe.
Oh, next thing you know what? I'm going to draw the line if they start trying to hold down a job.
Yeah. What they're saying is the millennials are being stereotyped.
Mischaracterized.
Yeah, they're reported. They're reputed to put off marriage, live in our parents' basements, work as baristas, and opt to live with our buddies. We don't have steady jobs. Student loan debt is sucking up our disposable income. The housing bust scared us off. And a survey of research by the U.S. Chamber of Commerce, of all things, found all this. The survey was dead on about my childhood Beanie Baby fascination. That is not me talking, folks. That's the author here. But less so with my housing situation. So this reporter, we're looking to buy a house. We're fine. We're good. Mm-hmm. No, the other part here, Sarah Stevens, she is the daughter of the CEO of the Mortgage Bankers Association. She's choosing to forego to buy a house right now. She knows interest rates are low, rents are high, and owning a home can build wealth. But she also had a front row seat to the worst real estate slump since the Great Depression. And she feels, the things have changed. Obviously, she saw that because her dad dealt with it every day. That was his work. He was the head of FHA. He worked as a lender. And now he's at the Mortgage Bankers Association. So he's, she grew up with him working in this business, and she's seen what happened. So she's a little skittish.
She saw him go from that full head of hair.
Yeah.
To the men's club for the men's club for hair.
Whatever it is.
Yeah.
Men's hair club.
Hair club.
I don't know, whatever. So a different perspective.
Hair club for men.
Yeah, hair club for men. Okay. A different perspective. But she has a different perspective than the author of the story, who's, my boyfriend and I are looking to buy a house. We're going to get married.
And we're freaks.
And we're freaks. Yeah.
Yes, we're going to.
So it's always dangerous to stereotype, and you hear this on the news, and a generation of people get stereotyped as this is what they are, and they're not. Obviously, all baby boomers, we're definitely not all the same. That's for sure. So,
in North Dakota, I don't think that's the case. I mean, your experience. I mean, this is a group that you actually are purchasing mortgages for probably, and mostly this is who you're purchasing mortgages for.
First-time homebuyer loans, our average age has been right around 30 to 32 years old. Now, is that unique to North Dakota? I don't know.
A little older now.
I'd have to look.
A little older than this group.
little bit older in this group, but in the same ballpark, you know.
And I guess, you know, the only thing that I notice a lot about, certainly this has been an increased trend in the last 6 years. I don't know that it's an increased trend, you know, in the last year or anything like that, or that we see more of it, is the amount of unmarried couples buying homes together.
Yeah, yeah.
That seems to me to be, and I don't have a stat on this, folks. I don't have a number to back this up.
Just your perspective.
But the perspective is that it seems like we see more and more couples who buy their first home together and they're not necessarily married. It doesn't mean they don't have plans to get married or anything like that, but they're certainly they're buying the home prior to.
And that's more of a societal change. I mean, you know, it's like we're together, you know, if however you think your marriage, I mean, if you want to go have a church wedding and the big thing, it's an expensive proposition. But we want to buy a house together.
We need some place to live.
We need a place to live. It's cheaper for us to probably buy a house than rent at this point.
Right. And the one thing to be aware of, just since we're on that issue, let's talk about it from an underwriting perspective or a title perspective. Because this is one of the things that where there are consequences. There's a difference between buying a house unmarried and married. And it has nothing to do with, you know, what your church says or what your parents say about that, although those are very important things you should consider in your life.
This is more related to the business
side. But on the
of
business side of it, one of the things that's important to understand is that in the underwriting perspective of being married versus unmarried, when you come to buy a house, let's say the relationship doesn't work out. So you buy a house together and the relationship doesn't work out. If you're unmarried and you're both on that mortgage, there's no way legally to separate you from that mortgage outside of paying it off. So that you could go buy a different house. So let's say you buy a house with somebody, it doesn't work out, you're not married, and now you want to go buy a house with somebody else. Well, when you come in to see me for your mortgage, I have to make your budget on your loan. I have to make your budget to include both payments. Yeah. Not half of both payments.
Both payments in full.
Both payments total.
Yeah.
And now one of the caveats of how marriage works in underwriting is that if you're married and you get divorced, you have a divorce decree that says that house belongs to the other spouse and they're responsible for the debt. And in underwriting, we can accept that court-ordered document as proof that you're not responsible for that payment, and we don't have to use it against you in your budget when you go to buy a different house. And so that's something to consider in terms of when you do buy a house but nobody goes into buying a house thinking it won't last. I mean, you know, people that you buy a house with somebody, you think it's a forever relationship.
Yeah. Well, it's true. And a deed, you're deeding your interest in the home to somebody else does not relieve you from the responsibility on the mortgage.
Right.
In either case,
I see people make that mistake all the time too. Well, I'm not responsible for that. I deeded it over to them.
In either case, where you're married or unmarried, that's the case. So you always want to make sure that the person, if you're leaving the situation, and the other person's the one that's supposed to be responsible for the house and the payment on the mortgage, is to make sure that they either get you a release of liability, if it's possible, off of that mortgage, or they refinance that mortgage. And a lot of times in a divorce decree, that'll be a requirement that the other person has to either the house has to be sold or refinance it within a period of time. Yep.
Yeah, the release of liability, I forget about that.
Yeah.
That technically exists.
That is available.
It technically exists.
And it is cheaper than refinancing.
There just aren't very many big shop lenders that'll do it.
Yeah, like we'll do it.
You call Wells or you call Chase and ask them for a release of liability. You're probably going to get put on hold.
Yeah, forever.
And ever. Yeah. But Bank of North Dakota and you guys, I mean, I actually have seen.
Yeah. So it is
as
important.
As long as the one person qualifies on their own to make the payment.
Yeah. So that you see that trend of unmarried couples buying a place together. That is something to be very cognizant of when you enter that, is that if it doesn't work out and you just move away, you're still responsible for that mortgage.
Yeah, it may actually be easier to deal with the Pope than the bank on that when you're trying to separate them out.
Yeah, because if that other person starts going delinquent, guess whose credit's getting dinged also?
That's right.
Both of you.
Yep, even if the other person is, and that works even if you were married and have a divorce decree.
Yes. Yeah.
If the other person's not making the payment, that's going to impact your credit too if you don't get off that loan.
Right. Yeah.
So
very important.
Something that you should consider too as we wrap up this subject and go to the next break and come back and talk about CFPB and how it's affecting lending, friction in the economy, and you have something on delinquencies.
It's good to be last.
It's good to be last.
And something we're going to tell you when it's good to be in last place.
Sometimes it's good to be in last place.
Yeah. Okay.
And but one other thing too is unless an attorney is telling you to, be real careful about ever signing off a deed unless you're also being removed from the debt.
Yeah,
that is one of the big mistakes we see.
Yeah, because if you sign that deed and you deed it, if we owned a house together, Joe, and I deeded my interest in that to you, then I can't go in and try and sell the place. If you died, I've still got a mortgage hanging out there. But if you died,
or if I quit paying the mortgage,
I have no ability to go and sell that house.
So I don't own the house, but I still would have to pay for it.
Right. Yeah.
Right. Yeah. So be careful with that. That doesn't always fix the problem. Well, never
fixes the problem. Yeah.
But okay, after the break, we're coming back. Why it's good to be last sometimes. CFPB
friction, systemic
it's
friction,
certainly protecting consumers.
Stuff.
Like I said, as soon as the place starts making money, shut it down.
Your news leader, weeknights at 6 and 10. Super Talk 1270.
And now for all of you youngsters, you've been very, very good tonight. I'm very proud of you. Here are the animals.
Yes, the animals.
Don't let me be misunderstood.
Dave Floor, Joe Sheehan.
The animals.
The animals. All right, well.
It's nice to be introduced by Ed Sullivan, isn't it?
Isn't it?
Yeah.
Yes.
That's pretty cute. All right.
So
okay.
the Fed, the CFPB rules are driving down mortgage lending. And we've talked about this a lot on this show.
Mm-hmm.
But mortgage rules imposed by the Consumer Finance Protection Bureau are driving down the number of loans banks are making. So says. Now, this is a bank group that's saying it.
Yes.
No. It's
the DBRS. Who are they?
This is coming from this is an activist rich banking group saying that the CFPB is hurting the number of loans being made.
Mm-hmm.
No, wait. Who is it that's saying it? The Federal Reserve.
No, really?
The Federal Reserve.
I thought it was the banks.
The Federal Reserve is saying.
Well, then
the Consumer Financial Protection Bureau is actually reducing the number of loans being made.
The Consumer Financial Protection Bureau is part of the Federal Reserve. That's where they get their money from, right?
Right. I don't know if this is like an autoimmune disease. Your body's attacking itself.
Okay.
I don't know how
like
this.
Yeah.
I don't know.
Okay.
The consumer. But Dave, Mr. Housing, you're kind of an expert.
Yep.
Our bottomless well of knowledge.
People have accused me of that.
Why would the CFPB drive down the number of loans being made?
Because regulations, Joe. Regulations.
Why is it keep coming back to that? What if we banned that word from the show? Could we even talk?
I don't think we could.
Could we even have a show if we banned the word regulations from the show?
We'd never.
The R word.
We'd never talk about
loans
again till this changes someday, if it ever will.
All right, so regulations.
It's regulations. That's what
Dave,
this Consumer Financial Protection Bureau does. Is they're a regulator, and part of the Frank Dodd Act, which everyone hates, it was created the Consumer Financial Protection Bureau, and their job is to enforce the Frank Dodd Act, and because Congress likes to write regulations or laws that are somewhat vague at points, so then you have regulators that have to interpret what the intent of Congress was. You have a lot of people that probably don't have a lot of experience in the mortgage world and lending, credit cards, whatever, writing these rules, and they're trying to protect the consumer. And have they gone overboard in protecting the consumer and actually end up harming the consumer in that by over-regulating?
Well, here's the good news. Because if you make less loans, if the banks make less loans, this helps out a lot more people.
How so, Joe?
Well, because, with less loans, you're definitely going to have less competition to drive up sales prices for sellers.
Oh, there you go.
Which is going to make lower prices for buyers.
Okay.
which
All
is
right.
going to, because there's less buyers.
Okay. Which is
And-
good for landlords because there's more renters then.
Wait, yeah, the whole thing.
Okay, so that's a good deal for.
Then rent goes up.
And rent goes up because there's demand for renters, or for homes.
And
so
when I last
then they
checked,
rent.
checked, renting has a massive impact on the economy.
Yeah, last time I checked.
Or is it? Wait, no.
No.
Home buying.
Home buying more so.
Okay.
Yeah.
Yeah. Why doesn't this work out for us?
It's just not good.
Less loans equals not good.
Yeah, and North Dakota is kind of a microcosm of this whole thing.
Yeah. See, we do. Yeah.
It's harder to get. The regulation makes it harder to get a loan today, and then there's more demand for rentals. So in North Dakota, we know what's happened.
We have a rental
when you
shortage.
have demand for rentals, is you have a shortage and the prices go up, and you have people getting kicked out of.
Yeah, but only per capita higher than New York City.
Yeah. But then
That's
you
not a
have
problem.
people sitting in
Williston.
mobile home parks in Williston that have their rent their lot rent, just to rent the land they got their home parked on, go from $300 a month to $800 plus a month. So that's helping everybody out,
but
isn't
they're
it?
all making six figures, so that's fine.
Sure, yeah. I mean, this is just helping everybody out. I
It
think
helps everybody
all
out.
this
Less-
regulation just helps.
Less loans to consumers is the solution.
So let's go to this article we talked
geez.
about, how economies collapse.
Okay.
This is from Tyler Durden
Wait, there's a
at
couple
Zero
of comments.
Hedge.
There are a couple.
Okay, all right.
So, of the 36 U.S. large banks that responded, almost 1 in 5 said the approval rate on prime residential mortgage was lower than it would have been.
1 in 5.
So,
okay.
so basically, how many of you are being left in the dust? Out of 5 of you that go in and want to be that would qualify or that would have qualified for home in the past,
I really want to buy a house.
They really want to buy a house. Of the 5 of you, 1 of you is going to get cheated out of your chance because the banks are tightening up.
Yep,
So
maybe.
So if you're at a party with you and 4 of your friends,
Just look.
1 of you is the loser in home lending, probably.
Yep.
The majority of responders, 78%, indicated the approval rate was about the same. The result, so they're basically saying they're approving the same amount of people, but they're cutting one of those approved people out.
Yeah.
Now, they're not arbitrarily doing it, folks. It's not like they're just saying, okay, who gets cut out, and they put.
No, there's a reason why someone's not making
So what
it.
they're saying is they're saying Fannie and Freddie will approve you for the loan. FHA will approve you for the loan. USDA will approve you for the loan. So all the guidelines will approve all 5 people. But we as a bank find that there's one of those people that's riskier than we want to do business with because of the new regulations.
Right. Yep.
And so we're going to leave them behind.
Yep.
Their score is a little too low. They don't have quite enough reserves in the bank.
You can go down
The
to
debt to income ratio is just a little higher.
You can go down the street and see if you can get one.
Right.
Yep.
But we're not going to do the loan for you because we're going to set our own floor,
Yeah.
our own
which
cutoff
happens.
rate that you fall below.
They're making a business decision.
Yep.
Yeah. So, but are you done there?
Well, the
You
results
got one
were
more?
the same whether the borrower had a FICO score equal to or less than 680, or if their credit was higher than the threshold. In fact,
okay.
Brian, Frank and Brian actually, the title, I didn't get to watch their video this morning,
Oh, I
but the
didn't see it
title of
either.
their video was a fail sale with an 800 credit score and 40% down.
Didn't work out?
It didn't work out. So you have somebody. So apparently the story was there was somebody who had an 800 credit score, which the highest you can have is 850.
Yeah. 800 is like
800 is
excellent.
You're walking on.
Like you're
walking,
getting the best of everything there.
Yep, you're in tall cotton.
Yeah.
And so 800 credit score, 40% down.
Okay.
So 60% loan to value.
Yep.
I mean, almost 50. So the bank's protected by almost 50% of the equity.
Yeah.
Almost.
Yep.
And supposedly this deal didn't go through
Wow.
or nearly failed.
Something with property or something.
Yeah. So anyway,
Crazy.
so it is obviously doesn't the credit score isn't always the reason. It's not just because somebody's got a low credit score.
Yeah.
That's not the reason
Okay.
banks are walking away from people. And then one more thing, 16 banks or 44% said approval rate was lower than normal, regardless of the borrower's FICO score. Still, 50% of the banks said the approval rate remained about the same. And I thought there was one more. Banks cited a 43% cap on debt to income ratios as a part of the definition. So even though the loan may be exempt, even though they might be able to go up to 45% and still get the approval, or like on FHA loans, you can go up to 54% and still get, or 55% and get approval.
Yeah.
What they're saying is we don't care if we get the approval from one of the agencies. We're capping the debt to income ratio at 43%.
Because they're still at risk of getting sued by somebody, and they want to be able to prove that, no, this loan met the ability to repay requirements under the Frank Dodd Act of that 43% cap. And they said, we're not going above that. Even though we could get approval, we're not going above that because that helps our case if we get sued on this loan, if it goes south. So, okay, so this goes to this article from Tyler Durden on Zero Hedge. How economies collapse, systemic friction and debt are self-liquidating. And what he's saying here is, if we pile on an additional source of friction, regulations, okay, eventually forward motion stops. It's like, he said his example is if you flatten the tires on a bike and it becomes much harder to maintain speed, and if you throw a brake pad on it, rubbing against one wheel gets harder yet, right? Makes sense. Okay. Well, in an economy, here's some examples of what they're saying is systemic friction. College degrees that cost 4 times as much but yield diminishing value in the job market. Okay, so you have a lot of college.
So I pay $80,000 to get my education degree to go make the starting salary $25,000.
Yeah, or as we said before, the millennials are baristas at Starbucks.
Right.
Okay. Millions of needless medical tests performed to maximize profit or deflect future lawsuits. Defensive medicine. Okay. That certainly creates a friction in the economy. Going to defense, weapon systems that cost 4 times as much as a system they replace while being less effective and more costly to maintain or repair. We don't need them. So the same thing happens in the mortgage world. Okay, we throw the ATR, the ability to repay requirement, qualified mortgage rule on, and even though a lender could get this person approved through FHA or Fannie Mae or whatever, they say no because of this friction that's placed on us, in that if we go above that cap of a qualified mortgage at 43%, we're more likely to get sued. So we want to be able to go in. If we get sued, we want to be able to go into court and say, hey, here's the paperwork that says this person's debt to income ratio was at 40%. So we met the qualified mortgage rule, and it just makes your case stronger. So that creates that friction against people wanting to buy a house. And you obviously, Joe, have a case where if I'm making $50,000 a year and my debt to income ratio is 44%, I might have a problem making my house payment down the road. You could see that happening. Mm-hmm. But if I'm making $500,000 a year and my debt to income ratio is 44%, I've got a lot more, we talked about this before, residual income left over. I don't have as much friction as the guy making $50,000 a year. I can handle the payment because it's so much, the difference in our residual income is so much greater. But I make $500,000 a year, but because my debt to income ratio is above that 43%, you're not going to give me the loan. And I can't go down the street to give me the loan because they're telling me the same thing, and the guy across town tells me the same thing. So, then you say, well, just go buy a cheaper house. Okay, but I want that one.
We actually had that. We actually had a couple of those instances where we had people who made literally in a year, they literally made more money than 6 or 7 North Dakotans might make.
Sure.
Families might make.
Yeah.
But because they had a bad year in business, so during the financial crash, their income was down. And believe it or not, their income was down.
Yeah.
And they'd have several $1 million in cash available. But we had to deny their loan because of the last year of business being down.
Yeah.
The expenses they carry would only leave them with $20,000 a month left over.
Only. Yeah.
Right. But the debt to income ratio
was too high.
Was higher than 45%. The debt to income ratio is 63%.
Yeah.
But with the debt to income ratio at 63%, they still had more money left over every month
than you or I did.
Than several families together might.
Yeah.
Have. I mean, you could actually maybe support 3 or 4 families on just what they had left over
for the year. Yeah,
right.
Exactly.
And we had to deny those loans.
Yeah, and this article gets into a lot more stuff about offloading debt onto the taxpayers and all this stuff, and it's a bigger issue than just mortgages. But that's how it relates.
Yeah, those folks
we've created friction in the mortgage market with all this regulation.
Those folks don't like being denied, by the way.
Well, I would imagine not. Yeah.
Turns out.
Okay. All right. So, Jim's kicking us off the radio again now.
All right. When we come back, we're going to talk about the economic. We're going to talk about delinquencies. Why it's going to be last. Consumer reports on loan officers.
All right.
Right now, 72.
Get the traffic and weather information you need anytime on Super Talk 1270 and online at supertalk1270.com.
And back with your mortgage animals on Mortgage Talk 101.
Yeah.
Joe Sheehan. Dave Floor.
The mortgage animals. Hey, we got a new name for us. All right, cool.
Eating loads for breakfast in the morning.
So, Joel, when's it good to be last in something? Whenever
do you want to
be last?
Whenever it's something bad.
Okay.
So
what would that be?
In the mortgage industry, it would be delinquency.
Okay. Well, let's talk about that then. Okay. This is hot off the press. This morning, it just came out. It was
foreclosures.
It was actually embargoed until 9 a.m. Central Time. So a good thing we're on at 11 because now I can talk about it. I can talk about it. This is the National Delinquency Survey from the Mortgage Bankers Association.
Hot off the press.
Second quarter summary. The delinquency, this is nationwide now, delinquency rate for mortgage loans on 1 to 4 unit residents decreased to a seasonally adjusted 6.04%. Okay, that's delinquency rate, 6.04, okay? So remember that number, folks. That's the lowest level since the fourth quarter of 2007. The percentage of loans in foreclosure at the end of the second quarter was 2.49%. That's down 16 basis points from the first quarter, and that is the lowest number of foreclosure inventory since the first quarter of 2008. The serious delinquency rate, which is the percentage of loans that are 90 days or more past due or in the process of foreclosure, was 4.8%. That's 108 basis points down from last year. And that is also the lowest level of serious delinquency since the second quarter of 2008. Okay, now where does North Dakota fit into that? Guess what? 90-day plus delinquency rate. Last place, North Dakota, 0.5%.
That's when it's good to be first at being last.
All loan types. Prime fix, prime arm, subprime fix, subprime arm, FHA, VA. North Dakota is in last place in every category.
Every category. The trifecta.
We hit the trifecta. Yeah, okay, now loans and percent of loans in foreclosure. Oh, we were beat out by the Cowboys from Wyoming.
Those dirty rats. That's just because they're slower at foreclosure.
They were at 0.52 and we're at 0.68. That's percentage of loans in foreclosure. However, FHA loans, North Dakota is in last place again at 0.74.
So we split the title.
We split the title there. All right. The change in foreclosure starts rate. So this is at the beginning of the quarter. How many loans had you started into foreclosure during that quarter? North Dakota ranked 13th. We're not doing so good there. But you know what? We still were down 1 basis point. That's because we're probably starting at a very low level to begin with. So if we have one loan that goes into foreclosure in the state, it bumps the number up.
Right.
Yeah.
Right. So that's based on a percentage.
It's percentage.
Oh, okay.
Yeah. We actually report to this. We're part of the survey. North Dakota Housing is. So our numbers are included in this. So we us with the first time home buyer, government loans, the most risky loans, and all that good stuff. Our
not
numbers
driving that up too hard.
Our numbers make up about half of the survey numbers for North Dakota. Mm-hmm. Not really. It's pretty good. What does that say? Jobs. I think
jobs
it goes
matter.
back to jobs again.
Jobs matter.
Yeah.
Incomes matter.
How about that? Yeah.
Disposable income matters.
Yeah.
Now, as far as we said, the national was about a little over 6% on delinquency, a little over 2% on foreclosure.
Yep.
What numbers do we want to see?
I would say be closer to what we are, like on delinquency rate at our agency. We were at 3.7 for a delinquency rate. That would be excellent if you had that nationwide, I think. Mm-hmm. So something 4, right around 4 would probably be pretty
That's
good.
what I was thinking. Anything under 5 for delinquency rate, and then foreclosure, anything under 2.
And
1 would be ideal.
And obviously North Dakota's at half a percent, and that's our agency. foreclosures, we're at 0.17.
But has it always been historically like that when we had the lower wages, or were we closer to 1 and closer to?
The numbers I have go back to the mid 90s, and if we look at you put it on a chart, it's pretty much a flat number straight across for our agency. And if you compare that with North Dakota, also pretty flat number. Rest of the country kind of goes up and down,
depending on what's going on with the job
North
market.
Dakota's basically pretty flat.
Okay, well, all right. So let's talk about the loan officer experience.
Okay,
what I learned at the conference.
Oh yeah, okay. Now we're actually getting into when you worked.
Here's the one thing about it. Believe it or not, people don't like getting home loans.
They don't like it?
They don't like getting mortgages.
Why? Because they have to, or what?
I guess because it's hard.
Okay.
Remember that one study we had here about a year ago? It was talking about how people would rather go to the dentist than get a mortgage. Yeah. But we found out some stuff about the consumer experience and about getting a mortgage and how people feel about what the problems are.
Okay.
One of the things, 1 in 4, only 1 in 4 shop for the interest rate only.
The 1 in 4, okay. Well, that makes sense. There's, how many people is that a good product for? Anyway.
Well, right, and I think the other thing too is really it doesn't matter how great an interest rate I promise you today.
Yeah.
It's do you close the loan or not?
Yeah, right.
So if somebody offers you 4 1/4, but they have a reputation for never missing a closing, but this guy over here offers you 4, but his reputation is he never makes a closing.
Yeah.
Yeah. So, but here's what we found out. Okay, 42% of the negative experiences, according to consumers, are loan officer driven.
Okay. All right. So I misunderstood you when you said interest rate only. I was thinking interest rate only loan.
Yep. So whoever
but
gives
they're not necessarily shopping the rate.
Right.
It is important. The reputation of the lender is what's
really important.
Is very important.
Yep.
Here.
1 in 4, just go whoever's giving the best rate.
Yep.
The 3 out of the other 4 are looking at other factors.
Yeah. So they're
Who am I working with? How did they explain it? What's the reputation?
Yeah.
Which is good to know. But 42% of the consumers said that 42% of the negative complaints about the mortgage process have to do with the loan officer.
Not staying in touch with them.
Yeah, because really the loan officer doesn't control a lot else.
No.
After they get the loan in.
Really, the only thing a loan officer can do, loans put in, and then it moves on to other people, underwriter, title company, whatever it might be. So really, the one thing the loan officer could probably do is maintain good contact with their customer, and say, here's where we're at this, today. Maybe weekly or something, and here's where we're at.
Now, here's where we were talking about how regulations affect the consumer experience, and we're making less loans, and it makes things harder.
Yep.
Well, here's not the other thing is 4 out of 5 people want to work with one person in the loan process.
Okay.
Well, because of increased regulation, that's very difficult to do.
Right.
I mean, really, it's you have to have so many specialized people to cover all the different regulations that at every different point in the process, now you got to ask yourself, when you're running a system, like I have to run a system, if the loan officer's done with their part and they hand it over to processing, does it make sense for the processor to call the customer directly or the loan officer?
Yeah. To get a piece of information.
Right. So if the processor talks to the loan officer and the loan officer calls the customer back, now the customer has to call the loan officer back, and then the loan officer has to go back to the processor. Yeah. Or does the processor just call the loan officer?
Well, and the other thing is...
But we used to not always even need really processors in the loan process.
Yeah.
And now we do.
The other thing is is something that lost in the translation between all the parties. I want this document, and the loan officer explains it a little bit different. The person hears it a little bit different, and they come back with something. Well, that's not going to work.
Exactly right. Yeah. And so... But 4 out of 5 want that experience, and I'm
that's
saying,
interesting.
I'm saying as somebody who runs operations, it's going to be very difficult for me to deliver that customer experience.
Yeah.
So but interesting, borrowers would pay 20% more for that.
Wow.
and they would pay up to 14% more for a 30-day or less closing.
Wow. That's good to know.
Wow.
All right. Okay.
So if you want to charge more as a bank, just do faster closings.
Next week. You have a guest next week.
NDAR, North Dakota Association of Realtors, coming in to talk about the transfer tax, folks. It will cost you a lot more to sell and buy a house if this gets through. So you'll want to hear about it and hear their perspective on it.
All right.
Next week, Mortgage Talk 101.
Okay, cool.
Have a great week.
Bye, folks.